Welcome. So this is our next Zoom video on business interruption insurance. You may recall that we previously provided you with a video on dealing with anti-maskers, those pesky people that refuse to comply with your house rules at your business around wearing a mask or socially distancing. And that video is available on our Converge blog, and so you can find it there. Today, we want to talk about business interruption insurance and generally what that is, some of the extensions to coverage that might exist in your policy to provide a broader range of coverage for you and a potential claim, as well as what's happening in this space with COVID, and then generally how to go about making a claim. For today's program, we have partnered with the Anderson Kill law firm. Anderson Kill is a national law firm that only represents policyholders, the people that purchase insurance, like hotels that need guidance on their claims, or when the insurance company denies your claim. Anderson Kill are the lawyers that you turn to for them to assess the coverages that you have and to potentially represent you to recover your claim against the insurance company. So thanks for joining us. Let me introduce to you the speaker from Anderson Kill, Mr. Marshall Gilinsky. Marshall is a lawyer and a shareholder at Anderson Kill, and we're fortunate to have him. For those of you who have followed along on our teleconferences that we've been hosting, Marshall has joined us on several occasions to talk about business interruption insurance, the claims process, and to generally give guidance to the hotel community around recovering on claims for insurance. My name is Stephen Barth, the founder of HospitalityLawyer.com, and I'll be facilitating the conversation. So, Marshall, welcome.
Good to see you.
Likewise. And I know you're just digging out of some snow up there, so I'm glad you could join us, and I'm glad you're home and warm and safe. To get us started, Marshall, generally speaking, we talk to the hotel community, we're talking to the hotel community, and these folks have property insurance coverage, right? The general types of policies. And so starting off kind of there, how do we end up with what the people in the industry say BI, or business interruption coverage? How does that kind of fit in there?
Yeah, it's very standard to have business interruption coverage as part of a property insurance program. The property insurance itself obviously covers you for the damage to your property itself. So I've got a hotel, I've got a fire or an earthquake or a flood or something that affects my hotel. It's going to cost money to fix the damage. So property insurance covers that. Business interruption insurance goes hand in hand with that, and it kicks in to cover you for your lost profits over the period of time it takes to repair the damage from the flood or the earthquake or fire, whatever it is that causes the damage. It's a fairly standard policy provision. There are, the policy terms vary. They can be a little broader and more generous, or narrower and less generous, depending on the type of coverage you buy. But it's common for almost every property insurance policy these days to come with business interruption insurance.
That's helpful to get us started. You said something I just want to clarify for the audience. You said to recover profit. Does that mean we're not making a claim for revenue and we're making a claim for profit after expenses? Or can you talk about that just a little bit?
Sure. The typical way, policy terms vary, but the typical way, baseline way you calculate the amount of a business interruption loss is you look at the amount of revenues you would have had but for the loss you back out saved expenses, and that generally leaves you with your covered business interruption loss. The typical way of thinking about it is the business interruption insurance is designed to do for the hotel what its business would have done for itself had the loss not occurred.
So we could put it like we're going to make the business whole, I think is what it would be. Is that a fair other way to put it?
Yeah, and then again, terms vary here and there, but that's the fundamental premise of it, yes.
Okay, and so we've seen some of these claims. We have a history of these claims over time when we've had hurricanes or maybe the oil spill down in the Gulf. Situations like that have arisen, causing the hotel to lose business. And that particularly, well, I don't want to get too complicated at the beginning, but certainly with the hurricane that does physical damage to the hotel, that then could trigger a business interruption claim, correct?
It probably almost always will, yes.
Okay.
I mean, it depends on the extent of the damage. The way that the claim typically works in that instance is you have coverage starting from the time of the damage and extended out for the time it takes to repair the damage. And then in most policies, there's a further extension of coverage for like what I refer to as a ramp-up period, where after the damage is repaired, it takes additional time to restore your business to the condition it was in prior to the loss. And there's typically an extension of coverage for a dip in performance over that extended period as well.
Very helpful. Okay, and then I think I jumped the gun a little bit when I brought up the Gulf oil spill, because that brings us into a conversation pretty quickly around how insurance companies could be interpreting policies these days to justify the denials of business interruption claims around COVID. But it's because I believe they're arguing that there's no physical damage to the property, which they're saying there must be in order to trigger this claim. Is that a fair description of what's happening?
In the COVID context, that is an argument that is being hotly disputed between policyholders and insurance companies, yes. And again, the policy terms vary from one policy to the next. But typically, to kick off the coverage under most property insurance policies, there needs to be some sort of physical loss or damage somewhere. Some policies don't use the word physical, they just require loss or damage. And the insurance companies, unfortunately, have taken the position that the virus and its impact to property does not meet that requirement. Policyholders vehemently disagree with that, and the issue is being litigated in courts across the country. And our view is, you take a piece of property that's otherwise perfectly suitable for use, for whatever it is, right? It could be an elevator button, it could be countertops, it could be the bathroom at the rest stop on the highway or in the airport, it can be the check-in kiosk. You take a piece of property that's utterly functional and you put a virus on it that can kill you if you touch it. That's physical and that's damage, because you don't want to touch or use that property at all anymore. No one will. Right. And when you think about why people have property insurance, right, it's to protect their businesses from situations where they can't use their property. And that's exactly what's happening in the COVID context. So, the insurance companies don't see it that way yet. And so, like I said, it's being fought out in court, unfortunately.
And did I read correctly that several sports leagues have now jumped into the fray with the insurance companies and trying to generate a recovery because I believe the insurance companies have made the same types of denials to them. But if so, these are pretty big players and we can all look to the results of their litigation, could we not?
It's not just professional sports leagues, it's businesses of all types across the country. Yeah, there are hundreds of these lawsuits that are going on.
Okay, very helpful. All right, so there's an area, at least for me, that I always find a little confusing, and it's around, as I mentioned at the beginning, the extension of coverage around the attraction concept. Can you talk just a little bit to the audience about, there's two primary prongs there. Can you talk about those a little bit?
Yeah, there are a lot of different extensions of business interruption coverage. Sometimes it's referred to as time element coverage. And I think the two that you're referring to, Steve, are attraction property coverage and loss of attraction coverage. And we can talk about those, and we can talk about others as well. I think those two are important in the hotel industry, and it's not unusual on hotel hospitality insurance programs to see either or both of those extensions of coverage. So attraction property coverage is designed to cover the hotel in the event where there's damage at an attraction property. The classic example is Disneyland, right? You have a hotel in Anaheim. Your business model depends significantly on people coming from out of town to go to Disneyland and stay at your hotel while they're there, or in Orlando for Disney World. If there's something happens at the amusement park that reduces the level of business at your hotel by 20, 30, 50%, whatever it is, you've suffered significant business interruption losses. So this attraction property insurance is designed to give you coverage even in situations where nothing happens specifically at your property, but rather there's damage at Disneyland that leads to a downturn in your business. So that's attraction property coverage, and it's not that uncommon. And it can happen, there's any number of things that could lead to that type of a claim, right? There are a lot of businesses in the COVID context seeking coverage under attraction property provisions. It's an unusual situation, but when you think about, for example, a business that's just, serves, let's say, a downtown market, right? In any city across the country. The thing that attracts customers to their hotel are business travelers that have meetings in town, downtown. And because there's been widespread damage to basically every office building in town, that attraction of business travelers is enormously diminished. So it's about as far-reaching of an attraction property loss situation as you can imagine. And so that type of coverage can be valuable. In contrast, loss of attraction coverage works differently, even though it has the same word in it. I think of it, it's like an ick factor. Loss of attraction covers a hotel for a situation where something icky has happened at the hotel, and as a result of that event, people don't come there as much, right? So there are specific triggers that are typically set forth in the loss of attraction provision that define what the icky thing has to be. And typical things you see are murder, suicide, an infectious disease, an outbreak of a foodborne illness, things like that, which, when for any business, but especially for a hotel, if you're affected by something like that, you're apt to see a downturn in business. And so the loss of attraction coverage is designed to help protect you against that sort of business downturn.
Very helpful distinction. And just so I can get back to my example of the oil spill on the Gulf Coast, the oil is coming up on the beach. I've got a hotel on the beach, right? And now nobody wants to come because the sand is covered with this gunk or ick, as you describe it. Does that fall into the latter category that you mentioned?
Those Gulf Coast oil spill from Deepwater Horizon, it was an interesting scenario because typically you need, so for example, for an attraction property, right? The rig off the coast is not an attraction property. Right?
Fair,
right. People didn't come to sit on the beach to look at an oil rig off the coast. But people did come to sit on the beach.
Right.
Right. And so if you have oil washing up on the beach And if the beach is improved to a certain extent, it's a little esoteric, but typically you have to have damage to property of the type that's insured under your policy, right?
Oh, okay.
And usually the type of property that's insured under many policies does not include land, right? So if there's, but there's an exception to that for things like that are highly manicured types of land, like a golf course or a beach. So if you have a beach and you add sand to it every year, or you actually make improvements to it, it's not just land, but it's an improved feature of your hotel. And having oil wash up on the beach does, in my view, it does trigger an attraction property type of loss, because you've got damage to property that attracts customers to your hotel, and you see a downturn in business as a result. So it's an interesting hypothetical that you presented, but because I remember when Deepwater Horizon happened, I spent a decent amount of time thinking about this, because we talked to some hotel clients about what was happening, and we looked at their policies to get a feel for the extent to which they had coverage for this. And it's the terms of the policy ultimately that are going to determine whether you've got coverage for something like that or not.
And let's make a point very quickly. Policy language changes with almost every policy. Is that fair?
There's variety. I mean, the way that a lot of these things work is common, but you change a word here and there, and things can become a lot broader or somewhat narrower. So yeah, the devil's in the details, and that's why some policies cost more than others too. I mean, you pay for those enhancements because they're valuable, and then when a disaster strikes, you expect to get the value of what you paid for.
Yeah, I think that's a very fair position to take for sure. Marshall, just so I'm clear, and I think that for the audience, if I don't have a proper BI claim, can I still recover under one of the extensions that you talked about?
Right. So some of the extensions that we talked about already, and others of them, they work differently from the standard business interruption provision, right? The standard business interruption provision that we talked about covers you for when there's something that happens at your property, and it takes a certain amount of time to to repair the damage at your property, right? So some of these extensions of coverage, attraction property is a good example, don't require any damage at your property at all. They kick in when something happens away from your property.
Okay.
So these two things, they work kind of side by side with one another to address situations that are different, right? So another standard provision is a contingent business interruption provision, right? This covers you when, even though there's no damage at your property at all, when there's damage away from your property that affects your suppliers or your customers, and you experience a downturn in business because of that, then that sort of contingent business interruption coverage applies. That's typical for, you can see the value most easily for something like manufacturing, right? So if I'm making widgets, and in order to make my widgets, I'm dependent upon a supplier of input materials, right? And that supplier is devastated by a tsunami, and I can't get the materials that I need to make my widgets, I'm going to suffer a business interruption. I'm going to suffer business interruption losses. In this case, a contingent business interruption loss. With hotels, there are contingent business interruption losses. They typically focus more on disruptions with respect to customers, right? Because the hotel, you think of what are the inputs to a hotel, right? Linens and food and things like that.
Sure. Right.
You tend not to see a total disruption of your business because there's a problem at with the laundry, right? You just find another laundry guy and you find a way to keep going, right? But disruptions with respect to customers is a different thing, right? And sure. So that's a place where you're more likely to see a contingent business interruption claim in hospitality.
Very helpful. I'm laughing a little bit inside because I'm not sure I've heard the word widget since law school, but yeah.
It's an econ phrase, right?
It is, yeah. And I actually studied economics, so I got a double dose of it, but exactly right. So it's a hypothetical product. Yes, go ahead.
I won't get too far off about the widgets because now it's a thing on your phone. Like my daughter was playing with it and there's like, look, Dad, I got a widget on my phone. And then I started talking about supply and demand and she looked at me like, what are you doing, Dad? Another important extension of coverage we mentioned is civil authority coverage, right? And this is another one of those where something happens away from your premises that has a profound impact on your business, right? And so if there's something, typically it's damage, loss or damage that happens away from your business that leads to some sort of government order, and that government order has a serious impact on your business, right? So COVID, obviously, this is enormously important in COVID because this is exactly what has affected so profoundly the hospitality industry, right?
Yeah.
So again, you have damage away from your premises, right? You might not even have had a problem specifically on your premises, but that gives rise to an order of civil authority, and the order of civil authority hurts your business, right? That's what civil authority coverage is designed to do as well.
And is that a specific addendum, or is that generally included in property policies?
It's a common, the civil authority coverage per se as such is an extension of coverage that's added to many property insurance policies. And it typically is measured by a certain amount of days worth of coverage that you have in like 30-day increments. So it's common that you have this coverage for 30, 60, 90 days, starting from the time of the order and going for as long as the order lasts or until the impact on your business is
that could be a significant claim for many hotels.
Yeah, depending on what's happened to your hotel. So I mean, COVID context, yeah, it's a very big deal. And you can see it happen in other contexts as well.
Okay, listen, that's very helpful. Okay, so let's start to kind of wrap up here, but before we go, I'm a hotel, and I've been living through COVID. What steps how do I assess, right? What's the first thing I want to do? I assume, look at my policy, talk to my broker or my agent. And if I'm not satisfied with that, then go to you guys. Is that how it works? And at what point do I need to give notice about my potential claims, and how specific does that notice need to be? That was a whole lot of questions, but pare them down for us.
It's always a good idea to if you feel like you have a claim, to talk to your broker about it and provide notice to the insurance company if you suffered loss or damage, right? That's always the safest thing to do. In terms of how to analyze the coverage, like we said, the key is looking and understanding what the terms of your insurance policy provide. So the first thing you do is you take out the insurance policy, you look at it carefully, you go over with your broker or another trusted advisor that knows their way around insurance policies, and you examine the quality of the coverage that you have for COVID, or I mean, this is really true in any loss situation, right? But it's especially true in COVID. Yeah, and so we've helped a lot of clients do that. We're not the only ones who can do that. I think brokers do a good job of that. And if you feel like you want a second set of eyes on it, lawyers who understand the insurance coverage world are a good resource for that as well.
Yeah, that's very helpful to know you guys are out there looking at that, because insurance policies can be challenging to interpret, as we have learned historically and are learning today. So I encourage the audience, just because you don't get a positive response from the broker or the insurance company, that doesn't necessarily mean that you don't have coverage. And that's why I wanted to introduce you to folks like Marshall and his team at Anderson Kill, because this is what they do all day long, each and every day. And they've been doing it for many, many years. And you just need to realize that it's just challenging sometimes to know where to turn. And so to have a resource like this available, I think is very helpful and crucial, particularly during these times. Marshall, I want to get back to one thing before I cut you loose, and that is, if I'm the innkeeper and I want to give notice to the carrier, because that's crucial. We've learned over time that if we don't give notice, that can give the insurance company some ammunition or a defense that they might not otherwise have had to deny the claim because they didn't get involved early. They weren't able to get involved early enough, do their investigation, et cetera. So we don't want that to happen. So your thought to notify quickly is important, but how specific does that notification need to be? If I'm the innkeeper, I'm not a lawyer, I don't necessarily understand insurance. Do I need to say I have a claim under business interruption, attraction loss, other extenders, or is it just generally I have a claim against this policy? Does that suffice?
Yeah, the brokers will be a big help in doing this, but there's typically not a lot of specificity that's required for just giving notice of a loss, right? You have a fire, you call the insurance company and say, hey, I've had a fire, right? If there's a flood, whatever it is. If you're losing money because of COVID, you say, we're losing money because of COVID. And the insurance company will investigate the claim. So there's not a lot of specificity that's required there. Obviously, you consult the insurance policy. Some have more specific requirements than others. But in terms of timing, yes, providing notice promptly is important. There's two other, if you're talking about timing, there's two other deadlines that are important also. There's usually a deadline for filing what's called a proof of loss, which happens a little later in the process. But there's a lot of variety in the policy provisions in terms of the timing of that requirement. Typically, the requirement flows from the date when the insurance company asks you for it. Right? And proof of loss it's a statement of how much money you lost and you're entitled to under the policy, and it's a sworn statement. It's a formal procedure. But typically, the insurance company will say, "Okay, we want a proof of loss," and then you've got a certain 30 days or something like that after they've asked for it. Other policies, however, tie the timing of the proof of loss to the date when the loss occurred. So it's important to be cognizant of that, because this is another one of those things where I've seen cases where if you don't meet the timing requirements, it can lead to a total forfeiture. And that obviously needs to be avoided. And then the third thing is a service of suit clause. And they're usually state by state minimums for this, but this is a deadline for if you haven't gotten paid on your claim, there's a certain period of time. Typically it's 2 years, but sometimes there's policy provisions that reduce it to 1 year. You have to file a lawsuit if you're going to collect on the claim within that period of time. So those are the three time limits that you want to be aware of: giving notice promptly, filing a proof of loss consistent with the requirements, and then a service of suit deadline.
Very helpful, Marshall. As usual, thank you very much for joining us today. We're gonna wrap it up with that. Great way to end it. And we wish you the best up there to digging out of the snow. And I'm sure we'll be talking soon.
Yeah, it's great to talk to you as always. Thanks.
Thanks, Marshall. We'll be in touch. Okay, everybody, thanks for joining us and thanks for watching. I hope you found this helpful. Bye for now.